Hello and welcome to Markets Today. I'm Lata Venkatesh. With me is Surabhi Upadhyay. Well, the markets didn't quite keep up with the color of my attire. The Sensex and the Nifty lost about 0.5%. But importantly for the Nifty, it's finished below the 200-day moving average. Yesterday, it looked like it had conquered that figure. Today, the butterflies come back in the stomach, especially if you're a bullish trader. However, the mid-caps did well. And on an average, the number of advancing stocks were more than the declining stocks. But choppiness ruled the roost. Hi, Surabhi.
Hi, Lata. Should I say it's my attire that the market was kind of swaying to? All right. Plenty to talk about. As always, let's start with the headlines. Selling resumes on Dalal Street with markets coming under pressure in the last hour of trade. The Nifty slips about 0.5%, closing below 8250. The Sensex loses 170 points. Fmcg stocks see selling pressure along with oil and gas and infrastructure names.
A day of stable financial earnings today. HDFC delivers another steady quarter with profit rising 8% and asset quality obviously showing a marginal improvement. That's never a problem with HDFC. Axis Bank beats estimates with an 18% increase in profit and a 20% jump in net interest income. Asset quality remains stable. The bank's board approves a hike in the FII limit to 74% from the current 62%.
In other earnings, TVS Motors sees a 74% jump in profit, but margins fall due to higher other expenses. Lower volumes pull down Ambuja Cement's top line, but margins beat expectations.
The mid-cap index rises 0.5%, outperforming blue chips. Sugar stocks gain between 0.5% to 5% as the government hikes import duty on sugar and scraps excise duty on ethanol. That's ethanol used for fuel blending. Motherson Sumi gains over 3% after winning a huge order from Daimler. KPIT Technologies tanks 20% on dismal earnings. Well, those were some of the headlines from the street today, and here are the experts that we have lined up on the show for you. Sanjay Dutt, director at Quantum Securities, will join in with his outlook for the markets. We'll also get you a slice of a very special conversation we had with an ace trader and fund manager at Blue Crest Capital Management, Ashish Goyal. Watch him. And from the earnings space, we will get you the managements of HDFC and TVS Motors and some others who spoke to us about their quarterly numbers.
All that coming your way, but let's start first with the action on the street. It's been expiry week on Dalal Street and volatility continues to rule the roost. Market slipped in the last hour once again despite a rally in bank stocks. We've got Anuj now joining in with a wrap of the day's trading highlights. Anuj, is it expiry? Jitters already setting in?
Well, if you're a trader and if you're worried by today's volatility, maybe you should not participate in tomorrow's trade because tomorrow really is expiry and things could go either way. But today also was so volatile. I mean, for a lot of traders, it would have been almost impossible to trade. But interesting thing was that the bank Nifty was holding out today. The mid-caps were outperforming, but still in late trade, the market had a bit of a slide. But the cash market volumes were really low. So this is essentially an expiry factor playing out at this point in time, with 8250 being the fulcrum for the Nifty. And that's the level which would be keenly watched out for in trade tomorrow as well. Let's talk about some of the stocks that led the market down. And there were 3 or 4 heavyweights which are pulling the index down. HDFC, as is normally the case, was down 2.5%. ITC was down 3%. And Reliance was down about 1.5%. Apart from that, telecom stocks, well, there was quite a bit of sell-off post-news on both these names, both reacting to earnings. Bharti Airtel was down 3%, and Idea, which actually had better earnings than Bharti, was down about 5.5%. Some other prominent Nifty losers included HDFC Bank, that was down about 1%. Maruti corrected a bit, down 1.5%, and Tata Motors was down about 2%. On the gaining side, Axis Bank came out with what looked like a really good set of numbers. That stock was up 3%. Ambuja Cement also reacting to earnings up 3%. And HCL Tech saw some short covering, up about 2%. In the mid-cap side, the stocks that stood out on the winning side, TVS Motor, that was up 4%, reacting to earnings. Symphony, which had a brutal correction, that was up about 10%. And Geometric again recovered, up 10%. But on the losing side, stock of the day today was perhaps KPIT Tech. That was down 20% first thing in the morning. and remained in lower circuit for the rest of the day. Alok Industries was down 6% and Gujarat Gas was down 5%. So expiry tomorrow, it's one of the most volatile series that we have seen, and maybe the expiry itself is also likely to be very, very volatile.
Yes, I take your point, Anuj, with the 200-day moving average now being given and the market definitely slipping or confirming lower highs and lower lows pattern. It is difficult to be extremely optimistic, and yet it is expiry day, so things could still go any which way. But the blues in this market have not yet blown away, that is for certain. However, the silver lining is the performance of the private sector banks. The Bank Nifty has done better and outperformed, not without good reason. We saw the ICICI Bank numbers. They did show stress points, but overall, because of better margins and better control over costs, they could counter the negative impact of the stressed assets. In Axis Bank's case today, there was even less of a complaint. Yes, the amount of restructured assets were higher compared to the third quarter, but the bank had always prepared the market for a 6,500 crore of stressed assets, and they're nowhere near that. They are a good 1,000 crores less than what they thought they would register in the form of stressed assets. Stressed assets came in for the full year at 5,500 crores. NPLs have not risen at all. Gross NPLs were just 200 crores more than the previous quarter. So the market gave, as you can see, Axis Bank a thumbs up. ICICI already got a thumbs up yesterday. And Yes Bank, another good set of numbers. HDFC Bank, especially during expiry days, is not very much in the limelight. And in any case, with not too much of FII participation, that's become a side show. But these are the banks that dominate the Bank Nifty, and you can see them, returning very good performances. Of course, the public sector banks are left. They don't have too much of a weight in the Bank Nifty, but the first few numbers that came from that quarter, Andhra Bank, State Bank of Mysore, they don't look too bad. So Bank Nifty holding out, but one is not very sure if that is enough for the Nifty itself to hold. And then, of course, the bulk of the PSU Bank numbers are yet to come.
Well, I guess the market can do with some good news. At least the private sector banks have been providing that. All right, let's move on and get some market opinion going. Sanjay Dutt, director at Quantum Securities, expects to see a 3 to 4% downside in the markets from current levels. He advises investors to invest in individual stocks instead of the indices.
We may just make a panic low of about 3-4% lower from the current levels in the next few weeks, depending on what the rupee-dollar equation turns out to be and what happens overseas. Numbers are not good. Here in India this quarter, even the future outlook is not looking that positive for many of the industry captains or any of the chief executives. So on balance, I think things are going to be rough. Retail investors should look at individual opportunities more than the Nifty levels or any index levels and decide, okay, 7,800 is a good time to buy or 8,200 is a good time to buy. Because you need to focus on individual stocks which have corrected, individual stocks which are continue to show strength even though the market is down about 10% from the highs. I'm more optimistic on good quality PSU banks, tier 2 PSU banks, like a Bank of Baroda or a Canara Bank or, those kind of banks, because I think they are going to be better positioned to actually for the multiple expansion as well as the margin expansion once credit offtake really picks up. So, and banks like ICICI Bank and a lot of the other private sector banks, everyone's hiding in them. They're over-owned.
All right, that was Sanjay Dutt's view. Not terribly pessimistic, 3 to 4% lower perhaps, but didn't sound gung-ho on the markets, clearly expecting them to trade in a lower range. Well, now let's come back to the earnings. It was a busy day for those of us who are tracking banks. So let's talk about the biggest name in the private banking space. Axis Bank, I gave you a little bit of a lowdown. The numbers were in line with estimates, but asset quality was certainly nowhere as bad as the market, as the company had guided. Ekta Batra is here with the details.
Thanks, Lata. Well, it was a good quarter for Axis Bank in terms of most of the parameters except for the net interest margins. Now, the NII was higher than estimates. The profit, too, was pretty much in line with estimates. It came in at a growth of 18% versus street estimates of around 17-odd%. This time round, the profits were supported by a higher other income as well as a higher operating profit. So this sort of negated the impact of the provisions, which were higher by around 40% on a sequential as well as on a year-on-year basis. Now, in terms of the asset quality, remember that what is commendable for Axis Bank this time round has been that for the entire FY15, the management has maintained its gross NPLs at 1.34 and net NPLs at 0.44 from the time they reported it in Q1 of FY15. So for the past 4 quarters, it's been flat at 1.34. Past 3 quarters, it's been flat at those levels. In terms of the internals of the asset quality, the FY15 stressed asset addition came in at 5,577 crores versus the guided 6,500 crores. Fresh slippages at 610 crores versus 700 crores odd, which is a positive on a sequential basis. Fresh restructured loans came in at around 1,540 crores, and this was in line with what the street was expecting, considering that the forbearance was ending this quarter, so that was expected to go up. And totally, the stressed asset addition, remember, came in below that guided 6,500 crores, which was a positive. The only negative was possibly the net interest margins for the quarter, which came in at 3.81, which compares to 3.93% in the previous quarter.
India's largest mortgage lender, HDFC, reported fourth quarter numbers today. The company's net income rose by over 10%, but this was a little below street estimates of 16%. Also the lowest in the last 1 year, last 4 quarters. Profit growth is also subdued, coming in at single digits. The stock took a hit in trade after the numbers, and this even as asset quality remains stable. NPLs have never been a problem for HDFC anyways. In fact, it has improved marginally compared to last year same time. Here's Keki Mistry on his numbers.
We are glad to say that the non-performing loan number continues to trend lower, and on 31st of March 2015, our gross non-performing loan number stood at 67 basis points, which compares to 69 basis points in both in March of 2014 as well as in December of 2014. If you look at a breakdown of that 67 basis points between individuals and non-individuals, individual non-performing loan numbers stood at 51 basis points, and non-individual non-performing loan numbers stood at 1.01%. The ticket size for individual loans, or the average loan that we would have given in the current year, and this is new loans, this is not loans outstanding in the balance sheet, only new loans, stood at 23 lakhs and 30,000 rupees. Last year, for the whole year, the average was 22 lakhs and 10,000 rupees. So the average loan amount has increased by 6% for individual loans. So if we take the total growth in individual loans, of course, after adding back the loans that we have sold in the previous year, then the 23% growth in the individual loan book would comprise of 2 parts. One is the increase in the average loan amount, which is about 6%, and the balance would be volume driven.
So that's the big bank numbers. But staying with earnings, let's also talk about the cement space. Ambuja Cement's reported numbers for the first quarter of this calendar year, largely disappointing the street, and Nigel D'Souza has been doing all that number crunching. He's joining in. Nigel, how did you read the numbers?
Well, Ambuja Cements has seen a sharp correction from the peaks that we saw in early March. So the stock has corrected a good 20% in today's trading session. The stock clearly bucked the trend, ended with a gain of close to around 3%. To take you through the numbers, on the top line there was a contraction of close to around 7%. So that missed our estimates by close to around 100 crores approximately. That's because the volumes did come in much below what the street was estimating. Came in only at around 5.35 million tons. That indicates a decline of close to around 9%. But that also tells you that realizations were higher by close to around 2% odd. The big positive, though, was that the operating profit moved higher, and that beat our expectations. It came in at around 20.7%. That compares with our poll, which threw up a number of around 20.1%, telling you that the EBITDA per ton was in the range of around 880 to around 900 rupees. And on a sequential base, that indicates a big bump up of close to around 40%, though on a year-on-year basis, it's telling you there was a decline of close to around 10%. Power and fuel costs, as well as freight and forwarding costs, both of them were lower by close to around 4 to around 7%. Profitability, though, took a much harder hit than the operating profit. That fell by close to around 40% because the effective tax rate, it jumped back up to around the 25% mark. Remember, on a year-on-year basis, the last time around, the effective tax rate was only around 11%, and also the other income did include some various write-backs. So because of that, in fact, the tax rate returned to around 25%, and other income as well came in lower by close to around 27%, further hitting the profitability.
All right, thanks a lot for those details, Nigel. And now from the auto space, the darling of the markets, TVS reported numbers. Some of them were below expectations, but Sonia is here. She tracks the stock closely. What did you make of them, Sonia?
Well, thanks for that. The operational performance of TVS Motor was below what the street was estimating. So in a sense, there was a disappointment over there. Despite seeing a top-line growth of 14%, the company actually saw a degrowth or a drop in margins by 50 basis points year-on-year. So revenues were up about 14%, coming in at 2,457 crores, while on the operating front, the EBITDA went up just 5%, while the margins actually fell to 6.1% versus 6.6%. That's because the other expenses have jumped up for the company. So other expenses went up a whopping 28% year-on-year at 449 crores, and the employee costs were higher as well. On the bottom line, the profits went up about 74 crores. That's because the tax expenses have come down at about 10 crores versus 20 crores earlier on. Now, the management said that they would continue to focus on increasing their revenue growth and increasing their market share and will not concentrate so much on margins. They also did mention that they gained market share in every market in the fiscal gone by, and they will introduce 2 new motorcycles in FY16. One will be the new TVS Victor and another high-powered premium bike. Back to you.
All right, Sonia, thanks so much for that. Let's now hear out what the management actually had to say for that about that performance and, more importantly, the road ahead for the company.
This year, as promised, there will be 2 new launches. Industry is likely to grow by 3 to 5% because of the rural economy, the slowness in the rural economy. However, we will grow much faster than the industry and gain market share. We are looking at a 14.5% market share for 2015-16, and in 3-wheelers we are looking at 27% market share from last year's 22% market share.
All right. Let's take a break now, but coming up, Sudarshan Sukhani will join in for a technical chat. We'll also listen in to an extraordinary fund manager, Ashish Goyal from Wall Street.